Today, we're diving into some critical insights about AMC stock, focusing on what's happening behind the scenes with volume manipulation and the hidden financial struggles of major players like Citadel. We'll explore how volume plays a pivotal role in understanding the stock's real movement, far beyond just the price you might see in typical reports. Plus, we'll uncover how Citadel's hidden debts could signal a much bigger problem for the short sellers. So, without further ado, let's get into it. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. When we think about stock trading, the first thing that often comes to mind is price. However, there's a much deeper story to be told when we focus on volume. Price is often viewed as the primary indicator of a stock's value, but in reality, price alone doesn't give us the complete picture. Think of price as more of an advertisement, something that draws attention, but doesn't necessarily reflect the entire story. The true narrative is revealed through volume, particularly how it interacts with time and order flow. To put it simply, volume shows us the intensity of trading activity at a given price point. It's not just about how much a stock is worth at any moment, but about how many shares are being traded and how quickly they're moving. For MC, this becomes incredibly important because the price you might hear about isn't always a true reflection of the market's actual sentiment. This discrepancy often arises because market makers, who have significant control over the stock market, can manipulate prices to serve their own interests. They might suppress the price to $5 when the real value, based on demand, should be closer to $10. This manipulation has been particularly evident with AMC, where despite high trading volumes and strong demand, the price remains artificially low. What does this tell us? It indicates that there's more going on than meets the eye. The market makers are using volume to control the price, and understanding this is crucial for any investor trying to navigate the complexities of AMC. Now, let's delve into how this manipulation of volume works. It's not unusual to hear about large volumes of shares being traded, causing the price to rise, only for the price to suddenly drop with a much smaller volume. This might seem counterintuitive, but it's a clear sign of manipulation. Here's how it works. Market makers control the order flow. This means they can decide where buy and sell orders are executed. One common tactic they use is routing buy orders to what's known as the dark pool. The dark pool is a private exchange where orders don't impact the public market. By doing this, they can prevent these buy orders from affecting the price, keeping it lower than it should be. This strategy is why you might hear about a stock like AMC trading with high volumes, but the price barely moves. Conversely, a small sell order can cause the price to drop significantly. The reason is that the majority of buy orders are hidden in the dark pool, effectively neutralizing their impact on the market price. This creates a false perception of supply and demand, which can be misleading for retail investors who are trying to gauge the stock's real potential. Understanding this manipulation is key. When you notice high volume with minimal price movement, it's a strong indicator that something isn't right. It suggests that the market makers are actively suppressing the price by controlling the flow of orders. This is a crucial insight for anyone invested in AMC because it helps you see beyond the surface and understand the real dynamics at play. So, what can we learn from volume if price alone isn't reliable? Volume gives us a glimpse into the true market sentiment. It shows us how many people are participating in the market and what their intentions are. For instance, when you observe a surge in volume, particularly green volume, it typically means that more people are buying into the stock. But if the price doesn't reflect this buying activity, it indicates that manipulation is likely at play. This is particularly relevant for MC, where the volume often doesn't match the price movement. In many cases, you'll find high volumes of shares being traded, but the price doesn't go up as much as you'd expect. This suggests that while there may be significant buying activity, the price is being artificially held down. Conversely, when the price drops significantly on low volume, it indicates that the selling pressure isn't as strong as it appears, but the price is being pushed down anyway. Understanding this relationship between volume and price is crucial for investors. It helps you see through the manipulation and understand what's really happening with the stock. For MC, it's a clear indication that there's more demand for the stock than the price suggests. But this demand is being suppressed by the market makers. This knowledge is powerful because it allows you to make more informed decisions about your investment. Now, let's shift our focus to the short sellers, particularly the hedge funds like Citadel that have taken significant short positions against AMC. These short sellers are in a precarious position, largely because of the very tactics they've used to manipulate the stock. With AMC, the lack of liquidity and the difficulty in locating real shares are creating a dangerous situation for these short sellers. Many AMC investors have held on to their shares from the beginning, refusing to sell despite the volatility in the market. This has led to a significant imbalance, where the demand for real shares far exceeds the supply. This puts immense pressure on the short sellers, who are finding it increasingly difficult to cover their positions. The result is a dangerous zone for these shorts, where even a small increase in buying activity can cause a significant price spike, potentially leading to a short squeeze. We've already seen signs of this with other stocks like GME, which recently rose by nearly 9%. This reflects the difficulties that short sellers are facing. The lack of available shares means that the shorts can no longer suppress the price as effectively as they once could. This creates a scenario where any increase in buying activity can lead to a sharp rise in price, putting the shorts in an even more precarious position. Another critical aspect of this situation is the financial health of the hedge funds involved, particularly Citadel. Citadel Securities reported $27 billion in securities sold, but not yet purchased at the end of 2023. This amount represents over 58% of their liabilities, indicating that they are heavily leveraged. This is a concerning figure because it suggests that Citadel is taking on significant risks that could have catastrophic consequences if things don't go as planned. When we dig deeper into these numbers, we find that the true situation might be even more alarming. Short positions, by their nature, have the potential for unlimited losses. Citadel might have used $27 billion to take short positions, but the losses they face could far exceed this amount. The fair market value of these securities can be manipulated on paper, but the reality is that the losses could be in the tens or even hundreds of billions. This puts Citadel and other similar institutions in a very dangerous position, where their reported numbers might not fully capture the risks they are exposed to. It's not just Citadel that's in trouble. Other hedge funds, like Virtu, are also showing signs of financial strain. Virtu has nearly $6 billion in financial instruments, with only $684 million in cash. This indicates that they are highly leveraged and could be facing significant liquidity issues. As we've seen with other institutions like Credit Suisse, which had to be bailed out, these financial pressures can lead to severe consequences, including bankruptcy or forced liquidation. The situation with these hedge funds is compounded by the fact that many of them are taking on new loans to maintain their positions. The lack of liquidity and the increasing difficulty in locating real shares are pushing them further into debt. This is a ticking time bomb because their ability to manipulate the market is diminishing, and they are left with mounting losses and insufficient capital to cover their positions. Given all these factors, it's more important than ever for retail investors to conduct their due diligence. The information provided by these hedge funds should be taken with a healthy dose of skepticism, as they are likely underreporting their risks and financial difficulties. The reality is that these institutions are in deep trouble, and their continued manipulation of the market is unsustainable. As we continue to monitor the situation, it's clear that the short sellers are running out of options. The market is starting to catch up with them, and their tactics are becoming less effective. This is a critical moment for MC investors, as the pressure on the shorts increases and the likelihood of a short squeeze grows. In conclusion, the dangerous zone that the short sellers, particularly Citadel, find themselves in cannot be overstated. The manipulation of MC's volume and the hidden debt of these hedge funds are key indicators of the challenges they face. As retail investors, it's crucial to remain informed and vigilant. The true story is told by the volume and the financial health of these institutions, not just by the price you might hear about. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.